Welcome to Time Capsule, where we analyze history to find lessons worth learning. Today we're going to compare the great financial crisis to the economic pain that we're feeling today in the United States. The reason it's worth comparing, and many people are expecting similar results to the great financial crisis, is because it's the most recent recession that we've seen. I'm going to exclude the pandemic recession because that, I believe, was a unique circumstance. And this will also affect you because it will give you greater understanding of how the current recession will affect you. More importantly, it will discuss the difference in real estate prices and the likelihood of a national decline in housing prices. Now, what caused the great financial crisis? A housing bubble. There was a housing bubble in the United States fueled by the availability of cheap credit and relaxed lending standards. This led to a surge in housing prices, which eventually became unsustainable. The Federal Reserve lowered interest rates from 6.5% in May 2000 to 1% in June 2023. People with poor credit were able to get their own house. Currently, the banking standards are much stricter inside the United States. Banks then sold on Wall Street the collateralized debt obligations, and the SEC also lowered capital requirements for major investment banks, allowing them to leverage their investments up to 30 to 40 times, creating like a super bubble, if you will. Now, the signs of the trouble. The interest rate started to rise in June 2004, and the federal funds rate was at 5.25%, and it was kept there until August 2007. In 2006, prices started to go down. Many individuals had borrowed 100% plus of their mortgages, and they were unable to sell houses because they owed money in excess of the sales prices. Many people had adjustable rate mortgages, which caused their payments to go higher. This caused people to be unable to pay and sell their homes. More than 25 subprime lenders stopped accepting redemption. By August 2007, the interbank market stopped moving money over monetary fears. That's the money between different countries. Central banks around the world tried to pump in billions of dollars to try to prop up the financial system, but unfortunately, too little, too late, so to speak. Financial institutions had trouble valuing the new toxic subprime mortgages. By winter 2008, the economy was in recession. February 2008, the British government had to nationalize Northern Rock, a major bank. March 2008, Bear Stearns was sold to JP Morgan for pennies on the dollar. Summer 2008, IndyMac filed for bankruptcy, one of the biggest in history to fail. Freddie Mac and Fannie Mae were nationalized, i.e., the U.S. government owns them. Something equivalent to by proxy. They're not full-blown government agencies, but close enough to consider. Lehman Brothers then collapsed. Known about the aftermath. More than $1.4 trillion was used to shore up the U.S. financial system. Fannie Mae and Freddie Mac were bought by the U.S. government, and the package stabilized the stock market. But the damage had already been done at this point. Unemployment reached 10%, and 3.8 million people were foreclosed upon. But here's the thing, though, about those foreclosures. It took more than 2 years to get to that point, though. This is not going to be like a one and done or such a dramatic shift, especially with the things that had happened in the pandemic, which I'll touch upon later. Give me 1 second. Now, what happened because of the great financial crisis? What actions were taken by the government and other agencies? Well, one of the main responses to the crisis was to increase the regulation in the financial industry. This included the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States, which introduced new regulation on banks, hedge funds, and other financial institutions. The increased oversight of credit rating agencies, because they were criticized for their role in the crisis, as they had given very good ratings to mortgage-backed securities, which were frankly crap. And the other thing that happened is there was a reform to the mortgage lending standards. The crisis was partly caused by the relaxation of lending standards and allowed many people to obtain mortgages who could frankly not afford them. So, should they have had them? No, because of the damage it did to themselves and to the overall economy. To fight this, there was a push towards tighter lending standards. And then there were also the creation of new regulatory bodies in some countries and increased international cooperation. Now, how does this compare to today? And now that we've established like what was the great financial crisis, well, one of the bigger differences is the inflation. In 2022, CPI in the US reached a peak of 9%, 9.1, if you will, versus in 2008 it was 3.8. So this is not comparable. We are in a period of higher rates of inflation. So the thing that you should take away from this, and I don't think a lot of people are going to like this in particular, is the Federal Reserve is keeping interest rates higher for longer, and I do believe that they actually mean it, barring major economic crisis. And the stuff that we're seeing in the banks, I do not believe that the Fed considers that as such, because it's still maintaining a stable economy. Now, if you start seeing the top 10 banks, like JP Morgan Chase and others, start to collapse, this will be a completely different conversation because of the effects that this will have on the overall economy because they are quote unquote too big to fail. And that's the reason also why their stock prices are doing fairly well at this point in time. And unemployment, we hit 10% in 2009 and went down to 8% in 2013. Right now, we're sitting at around 3 to 4%. Now, not many people are talking about this, but I think part of the reason for that is because of the stimulus that entered into the economy during the pandemic. So it created a lot of liquidity in the market. Now, people are talking about that, but we already stimulated the economy so much that this is creating unemployment or not, or preventing people from going on unemployment unnecessarily. And the other thing, too, is there's very generous compensation packages in major tech companies where they may have 4, 5, 6, 12 months where they are getting paid out, where they may not have to work and get their full salary. That gives them ample time to not have to worry about applying for unemployment or anything like that. And a lot of the layoffs have been in the tech industry in particular. Will we see more unemployment rise? Probably, I would say so, just because of the given high rates of raised by the Federal Reserve. So that would make sense. But will we hit that 10%? Not at all. I wouldn't think so. Now, now the value of homes. Now, this is the interesting part, or this is where many people will tell you that just like in 2008 and 2009, you're going to see a great financial collapse of home prices. Things are going to be sold at land value. We're not in the same place. In 2008 and 2009, the reason for that problem is there was people were over leveraged. They bought 100+% loan to value. We're not People don't do that as much. There were a lot more ARMs or adjustable rate mortgages. Most people have 30-year fixed debt. It's up 4%. Who's going to sell their house into that? Like to get a higher payment? I mean, yes, you're going to get some structural problems like I lose my job, I have to go elsewhere, I got to move across the country, people get divorced, people die. These things are going to happen. I'm not saying that you won't see that, but to expect to see that great a number of home price sale or home sales is unrealistic just because the economy is in much, much better condition right now than it was in 2008 and 2009. And it's just the sheer pent up demand is the reason why that the home prices are so stable. Because when the Federal Reserve lowered rates to zero on the federal funds rate, people were getting insanely cheap interest rates. If you're getting 2-3% mortgages, that's insanity. You may never see a mortgage inside the United States for the average person like that again. I think commercial may be the one sector which is going to be hit particularly hard versus the great financial crisis, because what's happening right now, and don't quote me on this, but I believe there will be $1 trillion of U.S. commercial loans rolling over into much, much higher rates, because they're the standard debt for in the United States for a commercial loan is an adjustable rate mortgage. This means that they're going to be paying much, much higher interest rates currently than what they've seen in the past. And then the other thing too that's going to happen that I don't see a lot of people talking about, I mean, perhaps a few, is that we're going to see a much tighter lending environment moving forward. This is just a general comment on the status of the financial markets or the economy in 2023. I will say that. Because of the flight of funds or the removal of deposits out of the monetary system and into, say, other alternative instruments like money market accounts, federal treasuries, because of the higher yield, and also the flight to safety, quote unquote, because people are concerned about the liquidity and losing their bank deposits in regional banks. There's going to be less loans originated or created by those banks. This means that the overall amount of loans available to, say, small businesses is going to drop. So this means if you have a small business, the loans will be more expensive and less available. So that will cause potential pain for these individual businesses because they may not be able to get the funding that they need moving forward, or it'll be much, much more expensive. Those are my thoughts on the comparison between the great financial crisis and the current economy inside the United States in 2023. Thank you.